Good evening, everybody. Trust we are doing great tonight. Hope you can hear me now. I can. Someone said that I can't hear anything, so I have not started was saying anything. So hope we are good tonight. Hope we are fine. So, good evening, everybody, once again. So apologies last week I could not make the class. So, however, this night we are here again. So, just like as we said earlier, um, our plan for this week and last week is foreign subsidiary. So, hope I want to ask a question first and foremost. Hope we read the note I dropped. No, I dropped a note for us that we should go and read it. It is very, very important. Please, did we read it? I doubt if we read it though. So, but don't worry, I'll share my screen now. I quickly want to send the streaming link to the group so that others will join on YouTube. So just 1 minute, please. I'm already sharing the link to the group. So just you can now start. You can start. So okay. So I'm done now. So we can start the class now. So tonight we are solving May 2019. Question 1 is a foreign subsidiary question. So before that, I quickly want to present the note I sent across. We need to look at that note. Okay, my volume. Okay, yes, I'm going to. Actually, I'm not a very loud person. So, but we are going to manage. We are going to manage my voice. You know, I'm not a very loud person. So please just manage my voice. Uh, Foreign subsidiary uh, is a situation, we all know that uh, foreign subsidiary is a situation where a parent company acquires a foreign subsidiary. That means the parent company acquire a subsidiary company that is in another country. So for consolidation purpose, we all know that for us to consolidate, we must combine the financial statement of the parent company and subsidiary together, right? Yes, and that's how foreign subsidiary is. So that is what the short introduction about foreign subsidiary. Parent company currency is not the same as the subsidiaries. And what are we going to do? What we are going to do is very, very simple. What we do is just what? To translate. We translate what? We translate the foreign subsidiaries currency to the currency of the parent, which is called functional currency of the parent. So then we consolidate. So in fact, when there is a question, I usually prefer when foreign subsidiary come out because it is usually straightforward. What are you going to do? We are just going to convert the foreign subsidiary to the parent, then we consolidate. So due to the stress of conversion, the additional information are not much. In fact, the additional information of foreign subsidiary are not much. But if we look at, is it not 2024? May 2024, the ICANN tested a lot of adjustments in foreign subsidiary then. I think we solved that question last night in Apex revision. So November 2024. Yes, thank you very much, Mrs. Esther. So that question is like we solved that question for like more than 3 hours in Apex revision last night. So, but maybe this diet again, we are going to solve another question. Maybe I can now upload that one so that we can watch it also. We don't know how a can examiner is coming. So now let's go. Let's quickly use like 5 to 10 minutes to discuss about this note. So now, if you remember, I said it earlier that before we do foreign subsidiary, we must know IAS 21. What's IAS 21? IAS 21 is what? IAS 21 is effect of foreign exchange rates, right? So, and that's the reason why I said before you can do a foreign subsidiary question, you must have an idea of IAS 21. So, for the people that have not read IAS 21, I have dropped the notes. I have also dropped the link. So, I'm going to update the YouTube link. So, you go back to it so that when we are converting and doing this, it is not going to be like film in our eye. So now let's go definition of terms. So number one is functional currency. So what's the functional currency? A functional currency is the currency of the primary economic environment in which an entity operates. Example, I am a Nigerian company. My company is in Nigeria. So my functional currency, the currency in which my financial statement is going to be paid, is Naira. However, if I'm a UK-based company, my financial statements must not show naira, it must show pounds, because that pounds is the functional currency of UK. So that is functional currency. Now, foreign currency is a currency other than functional currency. That means a currency that is not a functional currency. It can be pounds, it can be dollars, it can be euros, it can be cities, it can be safer and the likes. There are so many currency, yen and the likes. So that is foreign currency. Now, presentation currency, a financial statement of every company. The currency in which we are going to prepare it is called presentation currency. Now, these three are very, very important. The four items we are moving left: closing rates, opening rates, spot rates, and average rates. Those rates are very, very important when we are dealing with foreign currency transaction. Now, closing rate. What is closing rate? Closing rate is the exchange rate at the end of the financial statement. And if you remember when I talked about IAS 21, currency usually fluctuates. If you look, if you hear the news today, that what is the exchange rate naira to dollar, you will hear 1,005, 1,006. By tomorrow, it will increase to 1,651. So foreign currency keeps exchanging every day, day by day. So your rate today will not be your rate tomorrow. Mm. So so your rate today is not going to be your rate tomorrow. So and that is what we are talking about. So now go, let's pick all the currency one after the other. Closing rates is the rates at the end of financial statement, right? So what about opening rates? Opening rates is the rate at the date of acquisition. In foreign currency context, opening rate is the rate uh, of the date of acquisition. That means the date in which financial statement commences. Then we have spot rate. Spot rate is an exchange rate at a specific point in time, while the average rate is the average rate over a specific period of time. So those are the rates. They are very, very important. So apart from that, we need to learn how to translate. How do we translate from one foreign currency to another foreign currency? This is very, very key. This is very, very key. There are sometimes you will divide, there are sometimes you will multiply. So how do we know? So I said it during our IS 21 class. I said it. I said you are going to divide when the foreign currency is expressed as a unit of one, as a one unit to other currency. When we are solving, I will expatiate more on this. I will talk more on this. Why the functional currency, sorry. So let's continue, please. So where the exchange currency is expressed in one unit to functional currency, we are going to divide. So this is actually simple. Please don't let it get it twisted. It is very, very straightforward. Don't worry. Now, these steps in consolidation, it is very, very important. So when we are solving foreign subsidiary question, there are three steps. Number one, we are going to translate the foreign subsidiary financial statement. We will translate it to the functional currency. And how are we going to translate? It is very, very easy. Number one is income, expenses, and other comprehensive income. That will be translated using the average rates. Majority of the time, average rates or DOA rate, what that means opening rate. While assets and liability will be translated using the closing rates, while all your equity items will be translated at DOA rate. So if you look at my screen, I highlighted all these sheets for us because when we are translating, they are very, very important. Our income, expenses, and OCI, they will be translated using the DOA rate, but most of the time it is the average rate. Asset and liability will be translated using the closing rates. Then all equity items will be translated at the date of acquisition rate, which is DOA rate. Then post-acquisition profit will be derived using the balancing figure. So once we can translate, immediately we translate, we will now start solving our group account just like we know it. That is our step two. The step two is that we now construct our group structure. If you remember very well, we determine the capital and reserve of subsidiary. Then we calculate goodwill, which is our working note 3. So after calculating goodwill, then the additional thing we will do is that we must recognize exchange gain or loss on goodwill. We must calculate exchange gain or loss on goodwill and add it or subtract it to our retained earnings. So when we are solving question, I will talk more on this. This is foreign subsidiary. When you are doing foreign subsidiary, you calculate exchange gain on goodwill. And where is the format? This is the format. Our opening goodwill will be translated using the opening rate. We less our impairment. Our impairment must be average rate, then closing rate. Then we have a balancing figure. So this balancing figure is the exchange difference. It can be a gain or loss. Don't worry, when we solve question, I will talk more on it so that it is not be like we are just saying, we are just talking. Now, another thing we will do is calculation of exchange gain or loss on net assets. And this usually occur when we are solving P or L item. When we are solving P or L item, that means like that May, is it May or November 2024? When we are solving November 2024, when you are dealing with profit or loss items, you calculate exchange gain or loss on net assets, which will be credited to OCI. But all this is just something we need to know. Please, let's move ahead to our question, to our past question, so that all these things I have been saying since morning, it will now make sense, because I believe some people might even be sleeping now, that we are just talking. Because I notice people don't like reading like that. Like when you are teaching reading, people will just be sleeping in the class. So let's just leave all this reading part. Let's leave it. We are awake. Okay, okay. That's great too. That's great. Let's stay awake. Exam is very fast approaching. So yeah, let's go. This is May 2019 question 1. So we are going to solve one more for a subsidiary question, probably during revision period, or I might try to solve one more question, then I upload it on my YouTube channel. So if you check my YouTube channel, I've been uploading past question, So recently I uploaded piecemeal acquisition past question. So in case I don't think you can do that in the class, so we can just I'll just share the link. We can watch it up. So we don't know how I can come up. So that's about piecemeal acquisition. Then about foreign subsidiary, I said I'm going to upload do that means November 2020. That question we have solved it last diet. I solved it last diet. However, I discovered that that question, that solution is about 3 hours. And if I upload that on YouTube, there will be an issue. And when I share the link to people, people cannot access it. So what I'm going to do, I'm still looking at it. Maybe we are going to update the link so that I can share it across so that we can all watch. It's a 3 hours video. But for the time being, I will send the Excel solution. That do PLC. I'll send the Excel solution that I solve. I will send it across for us to check it, for us to use it for now. Then when we now find out the solution to the video solution, you now, so that's how we are going to do. So now let's start the question. Let's start the class. Let's start the class. Sorry, excuse me, please. Okay, sorry, excuse me. I'm very, very sorry. I just need to take a little water. So now let's go now. So now only PLC, a Nigerian company, acquire 960 million equity shares of who? Of Kemi PLC, a foreign subsidiary based in Brazil, on 1st October 2015. Right? Now, according to that information, Oyin is the parent company. They now acquire a foreign subsidiary, right? A foreign subsidiary in Brazil on 1st October 2015. So now, this 1st October 2015 is what, if you remember very well, that's our date of acquisition. That date is very, very key in foreign subsidiary. Very, very key. That is our date of acquisition. Now, for how much? For 1.08 billion naira. Now, Brazilian real, BRL. The functional currency and the presentation currency is BRL. Since acquisition, Kemi has operated autonomously on Onyi Group. Then they now give us the financial statement of the two companies, right? So they give us all the asset and the liability, the ordinary shares. So they give us that, okay, the nominal value of the shares is 0.50 kobo of both companies, the revaluation reserve, retained earnings, and the likes. Now let's move to additional information. Now let's look at the additional information together. I said it is the policy of Oyin PLC Group to recognize NCI at proportionate share of net assets. Please do we remember that whenever the group policy is at proportionate net asset method, our NCI will not be given. Please let's take note. The only time the examiner told us that okay, NCI is valued at full goodwill, that means fair value method, NCI might be given. In fact, majority of the time NCI will be given. But when it is this proportionate share of net asset, we will calculate NCI. That is note number one that we must take note. Then number two, when calculating exchange gain on goodwill, please let's take note. When we are calculating exchange gain on goodwill, when we are doing foreign subsidiary, we must calculate exchange gain on goodwill. It is very, very important. It is very, very important we calculate exchange gain on goodwill. So when we calculate exchange on goodwill, if it is full goodwill method, when the group policy is full goodwill method, that exchange gain on goodwill will be shared between parents and subsidiary, just like the note we just read now. However, if it's proportionate share of net assets, the exchange gain on goodwill will only belong to the parent company. So that's this information, additional information one, that's what it is giving us. Now they give us retained earnings of Kenny PLC as a DOA is 390 million BRL. That is the retained earnings as a DOA. Now that is number one. Number two, they said Kemi sells goods to Oyin at a cost plus. That means a markup of 33.1%. That means 1/3. At September 2017, Oyin held 15 million of these goods. And if you remember, this information is about what? The information about unrealized profits. Unrealized profit. They call it POP. But POP is what? POP is parent unrealized profit. However, in this question, it's not the parents. The parent company is not the seller here. If you remember, only PLC is the parent company. So it's the subsidiaries unrealized profit, which will affect the subsidiaries profit, right? Now, they said only purchased this at an exchange rate of 1.5 BRL. On September 2017, only sent a payment of 15 million to clear this into a group payable. Then Kemi received a recorded cash on 2nd 2017. That is after the date of consolidation. That's when Kemi recognized the cash. So this will do what? This will create it will create what? It will create cash in transit. That information, additional information too, it has created cash in transit. What is cash in transit? Cash in transit is a situation whereby a debt is settled between the parent and subsidiary. However, one of them has not recorded that cash or bank transaction. So if you look at this question now, Kemi received and recorded the cash on 2nd 2017. If you look at it, when is the consolidation date? The consolidation date is when? September 2017. Can you see? However, Kemi received and recorded that payment when? After the date of consolidation. That means on 2nd October 2017. So this transaction, it will create cash in transit. They call it cash in transit. That means one person has sent a payment while the other person has not recorded the payment as at the date of consolidation. The date of consolidation is September 2017. So let me also highlight this. Let me highlight this. Now, let's move to additional information 3. I said Kemi purchased a leasehold building for 375 million BRL, taking out a loan payable after 5 years. The estimated useful life of the building on 1st October 2016. That is before acquisition date. Is it before acquisition date? When is the acquisition date? Let's check. When is the acquisition date? October 2015. Okay, after acquisition date. So that building after acquisition date, then they now said what? Okay. The estimated useful life is 25 years with no estimated residual value. Now the building was professionally revalued to 450 million, in which it will create what? It will create revaluation surplus. Revaluation surplus. So the director has included, now this information is very key. They said the director has included the revalued amount in the statement of financial position. So this revaluation surplus, the asset was purchased in 2016. There is a depreciation. Then, however, in 2017, it was revalued to 450 million. So there will be a revaluation surplus. But this revaluation surplus has been included It is very, very key. If it has not been included, it will be a different ball game. It will be a different ball game. But the examiner told us that it has been included, right? So we must be very, very careful about it. Now, they said the company adopted a policy of evaluation of property. There was no difference between the carrying amount and fair value as at 30th September. And that's the information. And they give us the exchange rate. Look at the exchange rate. October 1st, 2015. We don't need it. Do we need it? Yes. That is the date of acquisition, DOA rate. Then September 2017, exchange rate is 5.0. That is the date of consolidation. Then the average rate. So all these average rates and the date of 2015, we don't need it. All we need is the one I highlighted as yellow. We need those two. Very, very important. Those are the one we needed. We needed this green one, the date of acquisition, and the date of consolidation. Now, let me quickly now ask a question now. Looking at this now, when we want to translate, are we going to divide or multiply? It is very, very key. Immediately you don't understand this, there is a problem in foreign subsidiary. There is a problem in IAS 21. If we don't know how to convert to one, so somebody say we are going to multiply. What about the rest? Are we going to divide or multiply? Let me see your comments. We are going to divide. Okay. Another person, divide. Okay. Another person, are we multiplying or dividing? Multiply. So 4 people have responded now. 2 said divide, multiply, divide, multiply, divide, multiply. So now let's settle it now so that everybody is going to understand. Everybody, we need to understand. It is very, very simple. Now, this is the rule. Please, let's listen very well. This is the rule. Now, when you want to convert from one currency to another, in foreign subsidiary or in IAS 21, effect of foreign exchange rate, this is your key point. Please look at the examiner. Look at my mouse here. Look at my mouse. This BRL to Naira, one of the currency is going to be expressed in 1 unit. One of them must be in 1 unit. One will be in 1 unit, while the other will be the normal currency. Now, if you look at this question, they said BRL to 1 Naira. So your key point is this: the one that has 1 Naira. That one that has 1 Naira is your key point. Another question can come in. This 1 Naira, this one that has 1, it can be in dollars, it can be in euro, it can be in pounds. So don't focus on Naira. One of them must have 1. That one is your own focus. That one must be your own focus. Now, the question you now ask yourself, that this one that has 1 beside it, you now ask yourself, is it functional currency or foreign currency? That one that has 1 unit, that's the one that has 1 beside this, is it functional currency or foreign currency? Now, if you look at this question, it is functional currency because the parent company currency is Naira, right? So the standard now says, if it is functional currency, if the functional currency is expressed in 1 unit, please divide. Please divide. And that's why I put it, I put it in that note. Go and read it very well. If the one that has 1 beside this is functional currency, please divide. But if the one that has 1 unit is foreign currency, we must multiply. And that is what they call direct quote. But if the functional currency has 1 unit, it is called indirect quote. Then we divide. And that settles the case. And that is how we are going to. So in any exam, let the examiner come with any question. We can now know how we can convert now. The one that has 1 unit beside it. Now ask yourself, step 1, which one has 1 unit? Step 2, is it functional currency of foreign currency. Now, if you look at the question, please, you are the only one, Mrs. Messi, you are the only one not seeing the screen. No, it's your network. People, are you still seeing my screen? Yes. I'm answering for people. Yes. People are still seeing my screen. So just calm down. The network will come back. So we have settled the case now. Everybody, we are going to divide in this question, right? Because of what? Because the functional currency has 1 unit. The functional currency is expressed in 1 unit. And when you go back to the IS-21 past question I solved, that was what happened, and that's how we solve it. So now let's solve this question. Let's solve this question and let's move on. So now let me present my Excel now. And we move ahead. So in our question, I said when we are dealing with foreign currency transaction, our first step is what? Is to translate. We must go to the financial statement of the foreign subsidiary, then we will translate. So that is our first step. So we must translate. So let me present my Excel now. So let me present my Excel so that we can now start our translation. Wow. My Excel has started up. It's wow. Shit. This again. So let me, please excuse me, please. I need to just give me 1 second, please. I'm trying to share my Excel screen so that we can start solving the question together. So are we with the question? Yes. Please, I've sent the question to your group. So now we can now see my Excel now. So now let's start solving the question together. So let me enlarge my screen. So when we are dealing with foreign currency, we must start with translation. So this is it. This is what we need to do. We must start with translation. So now our first step is to translate Kemi, right? Now, Kemi, we have agreed that in this question, we are going to divide, right? We are going to divide. So we are going to divide. Now, my question is, when we want to divide all our SOFP items, which rate are we going to use? Please, let's check our question. Is it the DOA rate or DOC rate? When we are translating our SOFP, DOC rate, yes. All our items in the DOC will be translated using the DOC rate. Please don't let us forget DOC rate. We are translating using the DOC rate. And what is our DOC rate in this question? What's our DOC rate in this question? Our DOC rate is what? Our DOC rate is 5.0, right? 5.0. While our DOA rate is what? 6.0. So now let's start now. Now, what are we going to do? We go to the financial statement. When we go to the financial statement, we pick the financial statement of. So please, let's go back to the group. Let's check the question so that we are going to be on the same page. Now, if you look at the question, if you check the question, the PPE of Kemi is 1.2 BRL. The exchange rate is 5, right? Yes. Now, BRL 5. Now, investment. The next item is investment. Kemi does not have an investment. We are giving his investment separately, which is 1 point. How much is the figure? We are going to make use of it later. Don't worry. Now, inventory. The inventory of Kemi is 4.5 million. Please, are we together? Are we together? Please, let's be together. Uh-huh. Let's stay together. Now, the inventory of Kemi is 450 BRL, right? And that is why we have 450 here. What is the exchange rate? The same 5. Now, trade receivable 420. What is the exchange rate? 5. Now, cash. Cash is what? 75,000. What is the exchange rate? 5. All item of SOFP will be 5, will be translated using 5. Now, we are now moving to ordinary share. We are moving to ordinary share. So, what is the exchange rate of, what is the ordinary share of ordinary share of Kemi PLC? $600,000, right? Yes. So, what is the rate we are going to use when we are dealing with our equity items? What is the rate we are using? Please, let's remember DOE rate. Thank you very much. It's our DOE rate. Please don't let us use DOC for PPE or the asset and liability and equity. Please, it is DOE rate. And that's why we quickly did what? That's why we quickly read, we went through that note together. So all equity items will be translated using the DOA rate. And what is our DOA rate? Which is 6, right? Now, revaluation reserve. All these items will be 6, 6, 6, 6. Now, all of them will be 6. All of them will be 6. However, there is a revaluation reserve. Please, let's take notes here. And that is the trap this question is going to have. Now, they said evaluation reserve. Please, let's go back to the question. If you see something in the revaluation reserve, now, revaluation reserve for parent company is dash. Why subsidiary was $90,000, right? Now, there is information in additional information 3. They said Kemi purchased a leasehold land for one amount. Then the depreciation amount is how much? Is dash. They gave us that depreciation amount. Now, they are now telling us that at the end of the financial year, which is as at 30th September 2017, the director revalued the assets. So when the director revalued the assets, it now creates a revaluation surplus. And if you remember very well, all revaluation surplus items is going to what? It's going to revaluation reserve. It's going to revaluation reserve. So since it is a revaluation items, it is going to revaluation reserve. What are we going to do? We are taking it to revaluation reserve. So invariably, this revaluation reserve, that revaluation surplus has been included. And that is what I was saying the other time, that we should take note. When I was reading the additional information, I said, please, let's take note to revaluation reserve. Examiner told us that it has been included. So since it has been included, that means this revaluation reserve is not as a DOA. This revaluation reserve is a DOC because it has been included. And since it has been included, we are not going to use DOA rates. So we are going to use DOC rates. Please, it is only this question, and thank God we are going to solve another question. So I will now show you that it is only this question, and it is because the examiner has told us that the revaluation reserve has been included. And that is why we are using 5 here. Ordinary all equity items is at DOE rate. Now, that is just by the way. Now, there's another twist to foreign subsidiary, and this is the twist. Now, please, let's go back to our question. How much is the retained earning in the SOFP? Please, if you check retained earning in the SOFP, you see 510,000. Now, examiner now told us that in the additional information 1, that the pre-acquisition profit, that means retained earnings as a DOA, is 390. So immediately when we are solving foreign subsidiary, please let's take note. We must split pre-acquisition and post-acquisition. And that's why I split it here. We are going to split it into pre and post. Post acquisition is 510 in the SOFP. Now pre-acquisition is 390, abi? Then you now deduct 590, 510 minus 390, it will now give you 120. And that's why I show this 120 here. So this 120, the exchange rate will not be a deal, it will be balancing figure. And how does that balancing figure comes up? We are going to explain it now. This post-acquisition will be balancing figure. Please, at all time, this your post-acquisition will be balancing figure in all the questions you'll be solving. Why all this, the rest is going to be a DOA rate. However, in this question, the examiner told us that revaluation surplus has been included. That's why this one is 5, right? So the rest are going to be a DOA, except this post-acquisition is going to be a balancing figure. Now let's translate. Now the rest, let's quickly finish up this work. All the liability are going to be a DOC rate, right? All asset and liability, they will be on DOC rate. So let's quickly fix that. So I think we are done. Yes, we are done with all items. Now let's use Excel to make our work very fast. So this divided by this, please remember very well, we are dividing. In another question, we might multiply you. So please don't let us sleep. There are some questions we are going to multiply. So here you are just going to multiply this times this. So we do this, then we do this. So we are translating all our figures. Now, ordinary share items, we also do this again. We get our 100,000. Revaluation surplus, we also translate. Let's copy the formula. It will give us 18,000. Now, this again, let's copy the formula. We also do that again. Now, we now need to determine this balancing figure. So, how are we going to determine this balancing figure? Please, let's stay with me. Please be with me here. Let me use one of my lecturers' language. Please be with me here. This balancing figure is somehow complicated. Now, if you add all these figures together, remember this is 1.2 million, right? This is 1.2 million. So this 1.2 million figure, it is the accumulation of all equity, abi. Now you now translate. We are now going to translate this 1.2 million. We will translate it using the DOC rate. Let me put it here. DOC rate. We will translate it using the DOC rate. So now, what is the DOC rate? The DOC rate is 5, abi. So this 1.2 divided by 5. So what is it going to give us? It's going to give us 240,000, abi. So now this 240,000, we are now going to add all these figures together. It must give us 240,000. So now what are we going to do? We are now going to say 240,000 minus this, minus this, minus this. So when we press our answer, it will give us 57,000. So this 57,000 will be our balancing figure. Please, that is our balancing figure. So this balancing figure, in all your questions that you are solving, you must determine this balancing figure. How? Very, very simple. Add all these together, we get our 1.2 million. You convert it back using the DOC rate. Why are we using the DOC rate? Because this figure is a post-acquisition equity. It is a post-acquisition. So you convert it back using the DOC rate, you get your 240,000. Then all this figure must be 240,000. So for you to get this figure, you just add all this together, then you deduct it from 240, you get your balancing figure. And that's how we get our balancing figure. That's how we get our balancing figure. Do I have any question? I have a question, Mr. John. Please, okay, can you go ahead with your question? Can you use the chat box? and just send your question through the chat box. Then I can quickly look at it. Please just use the chat box because we need to finish up this question tonight. So thank you, sir. Just type your question in the chat box. Let's quickly address it. Let's address it. So now we are done with translation. So please come again how to get the balancing figure. Now, balancing figure is somehow complicated. Yes. Okay, another person said, why did we translate the reserve using the closing rate? Okay, thank you very much. Now let me go back. So I'll use one stone to kill two birds. So I'll use one solution to answer those two questions. Now, please everybody listen once again. Now, all these figures, they are in your balance sheet. Please, all these figures, we took them from the statement of financial position. Now, the question I will now ask that your statement of financial position as at which date? Please, if you go back to the question, this statement of financial position items is at that DOC date. So invariably, all these dates are as a DOC. However, please let's take note. When we are converting, we are not using DOC rate though. We are using DOE rate. Why? Ordinary share did not change. Reserve changed or not changed. Then pre-acquisition profit. All these items, they are majorly from your balance sheet. So, and that is the reason why we are converting using the DOC rate to get this final figure, this 1.2. So that's number one. Now, to get the balancing figure, please be with me again. To get the balancing figure is usually complicated. Let me don't lie for anybody. Everybody, it usually gives everybody problem. But this is how you get it. Step number one, convert this 1.2 million, convert it back using the DOC rate, you get to 40,000. So immediately you convert it back, you get your 240,000. Now we have already calculated 100,000, we calculated 18, calculated 16, 5,000. So what are you going to do? Subtract 100,000, 18,000, and 65. Subtract it from 240,000 that you got. If you subtract it, then you get the balancing figure. You subtract these three items from your 240,000, you get your balancing figure. And that's how you'll be getting your post-acquisition every time. So that is just about that. Please, let's continue. Let's continue. Our time is going. Our time is going. Now, someone just asked that, why are we giving the average rate? Please, examiner give us the average rate just to confuse us. We don't need it. We don't need average rate. Let me say it once again. We don't need average rate. If this question is SOPL, that means statement of profit or loss account, then we are going to need the average rate. But in this question particularly, we don't need average rate. Examiner just gave us to confuse us. So, but we know what we are doing here. So we are just going to ignore it. Please ignore it. Whenever you are dealing with SOFP, with foreign subsidiary, and you are giving average rate, please ignore it. We don't need it. The only thing we need it for, if we have POL items, that's what we are going to deal with. So now we have translated Abby. So now let's start our consolidation. Let's start our consolidation. Now, when we start our consolidation now let me quickly pick all these items. Let's remember, please don't let us forget, when we are consolidating, we are not picking BRL again, we are picking Naira. So we are picking Naira to our solution page. So let's go to our solution page. Let's put them here. Let's just copy them here. Let's just copy here. Let's copy and paste special. And let's paste value. Let's paste value. So this is our PPE for parent company. So should I on don't let me, please let's continue like this. So what's the PPE of the parent company? PPE of the parent company is 945,000 plus, now we are consolidating now, plus how much? Plus 240,000, which is a subsidiary, right? Now, goodwill, our working note 3, right? Now, investments. Our investment is how much? For parent company is how much? 180,000. 180,000. Yes. Please, let's go, let's go, let's go. Let's start our calculation. Our time is going. Now, plus, what is the investment of subsidiary? They did not give us, so it will be 0. Now, inventory. What is the inventory of parent company in the balance sheet? They gave us 375,000. Now, what is the inventory of, this is the inventory of the subsidiary company, the converted one, 90,000. Now, let's go. Trade receivable. What is the trade receivable of parent company? 300,000, right? Yes, 300,000. Plus, what is the trade receivable of subsidiary? 84,000. Sorry, which is this 84,000? So plus 84,000. 84,000. Now, cash. What is the cash of parent company? Cash of parent company is how much? Is 90,000. Plus, what is the cash of subsidiary company? The one we translated, 15,000. Please don't let us forget to, we are not picking the foreign currency again. No. We are picking the translated. So let's move. Let's move. Equity items. Ordinary share. Parent only, right? Parent only. Parent only. How much is the parent only equity? 450,000 naira. Now, reserve of the parent company. Revaluation reserve of the parent company. So please, if you remember very well, we are taking the reserve of the parent company, which is 0, Abi. It is 0 for the parent company. But for subsidiary company, what is the reserve of subsidiary company? Let's go back. Reserve of subsidiary company. How much is it? 18,000, right? So let's copy. Where are we taking this 18,000 to? For the subsidiary company, we are taking it to working note 2, right? Working note 2. Is it as a DOA or DOC? Is it as a DOA or DOC? That 18,000, we are taking it to DOC. We are taking it to DOC. So is that not our reserve? Yes, 18,000. Now, let's quickly deal with ordinary shares then. What's the ordinary share of the parent company? 100,000. So 100,000 for the parent company, 100,000 for the for the subsidiary company, sorry. So this will be 100,000. Then this will be also 100,000. Now, retain earnings. Retain earnings. So let's move to retain earnings. Retain earnings. So retain earnings of the revaluation reserve of the subsidiary company as our DOE is 0. We know that it is 0 because we are not giving. If you look at the additional information one, they did not give us a valuation reserve of the subsidiary company. Now, retain earnings of subsidiary company. Look at it. Look at it. Please look at my screen. This is the retained earnings. You remember we have DOA and DOC, Abi. This is DOA and this is DO. This is pre-acquisition and post-acquisition. So this is 65,000, Abi, and 57,000. Now, if you go here, as a DOA, they told us that the retained earnings is 65,000. Then post-acquisition, 57,000. Post-acquisition is 57,000. Then date of DOA is 65,000. So to get this DOC, even though we don't need it, we can do this plus this. Because if you remember, our post-acquisition is B minus A, right? It's B minus A. So B minus A will give us our post-acquisition profit. However, this post-acquisition, we have already calculated it. This is it. It is only in foreign subsidiary you will be calculating post-acquisition by yourself. The rest, we are the one that will do B minus A here. Now, that is just by the way. So which figure do we need again? We need other figures. We need the liability figures. So let's quickly pick all this liability. Let's take them to our solution page. So let's take them to our solution page. Now let's input them so that we can now start solving. Sorry, excuse me. I need to pay special. I need to pay special. So please, are we together? Yes, we are still together. We are still together. We are together. Please, let's be together. People should not sleep. Oh. Please don't let us sleep. Oh. So now, what is the loan note of parent company? Loan note of parent company. What is the loan note of parent company? Loan note of parent company in the question, okay, 300,000. 300,000 plus note of subsidiary company, 75,000. Now, 8% redeemable preference shares for parent company. How much is it? 90,000 plus redeemable preference share of subsidiary, which is 30,000. This 30,000. So it is 30,000 for subsidiary company. Now, let's move to trade payables. Now, trade payable of parent company is 105,000 plus trade payable of subsidiary 60,000, right? 60,000 plus 60,000. Now, taxation. Taxation. What is the taxation of parent company? Oh, trade payables is, we have mixed it together. Yes, we have. Let's copy this. Let's paste it here. So trade payables of parent company. Yes, trade payable of parent company is 375,000. I've mixed it up. Yes, 375,000. Yes, thank you. Thank you for bringing that up. 375,000. 375,000. Then plus subsidiaries trade payable, which is 60,000. So this one is 105 plus 24,000. So we have to delete this 60,000 and put 24,000. Now bank overdraft. How much is bank overdraft of parent company? They gave us, which is 45,000 plus the subsidiary does not have overdraft, right? Yes. So we can now delete this. We don't need it again. Please don't let us forget our solution page. The parent company is OE PLC, right? Consolidation financial statement as at which date? As at 30th September 2017. That is the date of consolidation. So we are done with our balance sheet now. We have emptied our balance sheet. Now, what next? We can now move to additional information. We move to additional information. Let's move to additional information. Let's move to additional information. Now, additional information number one. What does the examiner say? I think that additional information, we don't actually need it, but let's look at it together. Let's look at it together. They said it is a policy of owning group to recognize NCI at acquisition at proportional share of net asset method. Okay. The retained earnings as at DOA is 390 million. And we have used that information. Please, we have used it. This is that information. We have used it. So retained earnings as at date of acquisition is 390. Then we translated to 65,000, right? And we also use this 390 to get our post-acquisition of 120,000 so that we can now get our balancing figure here. So we have used that 390. Now, but they told us one information. The information is that they said NCI is valued at proportionate share of net assets. So what that information is telling us is that our NCI value at DOA, it will be how much? It will be NCI percentage multiplied by this 65,000. So there is a trick I need to add to us now. So let me put that trick here so that we'll be remembering in this figure that you determine here. This figure is going to working note 3. Now, this is it. Anything that we get here, anything that you get here, this figure is going to your working note 3. Is coming here. So that 165,000 is coming here, which is net asset of subsidiary. Then also we are going to use it, that figure, we are going to use it to determine our NCI value at DOA. So can we quickly deal with that? Yes, no, but let's leave it first. Let's leave it first. Let's go to additional information 2. I think let's go to additional information 2. Please, let's go to additional information 2. Now, additional information 2, are we there? Yes. Yes. Let's go to additional information 2. What does additional information 2 say? It says Kemi PLC sold goods to OE at a cost plus, which is markup, right? Now, they said the markup is at 3.1% at September 2017. Only held 15 million of these goods. The goods were purchased at an exchange rate of 1 million to 5 BRL, sorry. Now, then only sent 15 million payments. Then Kemi receive it, blah, 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 right? Now, let's quickly deal with the additional information. So after we deal with our additional information 2, we deal with additional information 2, then we now balance up our account, right? I think we can do it in that way. Let's do it in that way. Let's do it in that way. Now, let's go now. That information is about unrealized profits. So now let's go and calculate our unrealized profits. Now, that will be our working note 2. Our working note 2 is what? Calculation of determination of unrealized profits. Unrealized profits. Now, this unrealized profit, it is not for the parent, it is for the subsidiary company. Now, it is usually called URP. And URP, what's the formula for calculating URP? I always say it every time. The formula is straightforward. It is called margin multiplied by value of unsold goods. Value of unsold goods. Please, your formula will remain the same. At all times, you must not change this formula. The only time this formula can change, I have said it, is when the cost value of that inventory was given. If it is cost value, then your formula will change. It will be markup multiplied by cost value of that inventory. But if it is the value of inventory that they give us, it is margin. Now, let's go. In this question, they give us markup. Markup or cost plus, right? They call it markup or cost plus. So, what is this? What did they give us? They said 33 1/3%. That is the markup they give us. Now, what does our formula say? Our formula say margin. But the examiner will always give you markup. So what are we going to do? We are going to convert margin to markup. We convert markup to margin. At all time, please, when the examiner give you markup, you convert to margin. We convert to margin. So we convert markup to margin. And converting markup to margin is very, very straightforward. It's not a big deal. It's not a big deal. It's a very simple something. Now, this markup that they give us is that 3 1/3 AB. Another thing, if you press our calculator, press everything, it is 1/3. This that 3 1/3 is the same thing as 1/3. So if you want to convert your markup to margin, it will be how much? It will be 1/3 plus 1. So it will be numerator all over denominator plus numerator. So when we convert our markup to margin, it will be how much? It will be 1/4. So converting markup to margin, our margin is equal to 1/4. So our margin is 1/4. It will be 1/3 plus 1. It will be 1/4. So our margin is now 1/4 because we have converted to margin, right? Yes, we have converted to margin. Now, what is our formula? Our formula is ULP is equals to margin times value of unsold goods. Margin times value of unsold goods. So now let's calculate our unrealized profit now. We have determined our margin. So our ULP, unrealized profit, is equal to 1/4 multiplied by value of unsold goods, 15 million. They give us that the value of inventory as at that date is 15 million. So therefore, ULP is equal to 1/4 multiplied by 15 million. So it's going to give us 3,750. So when we press our calculator, our ULP is going to be 3,750. Unrealized profit will be 3,750. And what is the adjustment? What is the accounting treatment that we are going to pass? So we will debit one thing, debit, but in group account, please let us forget about journal. We are going to less this amount from our inventory, consolidated inventory, and retain earnings. Retain earnings. How is retain earnings of the seller? Please let's take note of the seller. Parent can be seller, subsidiary can be seller. So in this question, who is the seller? And that's the reason why I'm putting that formula here. The seller is who? Kemi Abi. Kemi is the seller, right? Yes, Kemi is the seller according to the question. So we are going to deduct it from. Okay, somebody say I should zoom. Please, I have zoom. Yeah, let me zoom more. Okay, so I have zoom now. On the people on YouTube, I have zoom. Yes, I think I have zoom now. So who is the seller in this question? Is it parent or subsidiary? Is it parent or subsidiary? Subsidiary, right? So we will deduct from subsidiaries retained earnings. So we deduct from subsidiaries within. So we less from consolidated inventory, then less from retained earnings of the seller. Who is the seller? Kemi PLC. So subsidiary is the seller. So now let's quickly pass that accounting entries. Now let's quickly go. Let's go back to our inventory. Where is our inventory? So what are we going to do? We less 3,750 from our inventory. Then we less uh from our seller. Who is the seller? Subsidiary. Where is the retained earnings of the subsidiary? This is it. This is the retained earnings of the subsidiary. So we now say unrealized profit. Unrealized profit on unrealized profit on inventory. On inventory. Which is what? Relevant workings. Relevant working notes 2. Abi? Relevant working note 2. Now, please, all the adjustment we do in additional information is going to your DOC. Please, let's take note. They are all going to your DOC. At all time, going to your DOC. How much is it? Minus 3,750. So, remember, B minus A, Abi? B minus A. Imagine, is equal to B minus A. So we get our post-acquisition like that. So this one, okay, we determine this one by ourselves. Now, this is what we are going to do. This post-acquisition reserve, please, let's split it. Post-acquisition reserve, retained earnings is going to be how much? It's going to be this and this. Please, let's take notes. This and this. Because we are going to distribute this between NCI and parent company. Why this one? Post-acquisition reserve is 18,000 face value. So it is usually recommended to split these two amounts. Let's split it so that when we are distributing between parent and subsidiary, it will be very, very fine. Now, additional information 2 also says that parent company now sent an amount to the subsidiary company. Abi, parent company sent an amount 15 million to the subsidiary company. However, the subsidiary company did not do what? Did not record it until after the date of consolidation, which is October 2. And I said what? It will create cash in transit. It will create cash in transit problem. They call that problem cash in transit. When the parent company transfer money to the subsidiary, it is going to cause cash in transit problem. Now, let's go. So it is called intra-group. Sorry, excuse me, please. Intra-group balances with cash in transit. Sometimes we have cash in transit, we have check in transit, then we have goods in transit. So this is cash in transit. So how do we treat cash in transit? So now cash in transit affects 3 legs. It affects your receivable accounts, it affects your payables account, then it affects the problem going on, which is what? Cash account. Now, please, this cash in transit is usually a problem. I know it is a problem. It usually gives so many people issues. Please, let's listen very well. How are we going to treat it? When we are dealing with cash in transit, it does not involve calculation. It does not involve you calculate this, or it is very straightforward, but it is somehow complicated. So please, let's take note. Now, this balance we are talking about, how much is it? 15,000. Abi, that 15,000, it's supposed to be less. If you remember, why are we doing this? Because according to the consolidation rule, they said intra-group balances must be eliminated. So our adjustment is that we are supposed to less 15,000, which is 15 million from payables, then we less 15 million from receivables. However, one of them did not receive money. One of them did not receive money, and that is why its cash came in. So now this is how we are going to do it. How much is that that something in transit? Cash, Abi. So we are now going to add that cash. You add it to your cash. Now, what are we going to do? So this cash, you are now going to subtract it from both of them. So this one will now be zero. Now, the trick here is that these two amounts should be 15,000. But due to one reason or the other, cash in transit occur. So what are we going to do? We are adding 15,000 to this, while the difference will affect one of them. Now, there is something I want us to take note. Your receivable must be higher at all times. Your receivable must be higher. Whenever there is cash in transit, please take note. Your receivable must be higher. Your receivable must be higher. By what? This receivable must be higher whenever there is cash in transit. By what? By the difference of this wahala. The difference of this cash, it must be higher. And that is the reason why we said, now, we now see 15,000 minus 15,000. And that's the reason why this one is zero. Please, do we get that? Please, do we get that? I know this usually cause problem. This usually cause problem. And it is very, very simple. Yes. Always hold receivable at 0%. Yes. That receivable must be at 100%. It is your payable that will be affected. Now, to get this scenario, let me paint a scenario. Now, this is the scenario, and that is how you can understand it. If I don't paint a scenario, I don't think people will understand it. What is the scenario? Now, parent company owes the subsidiary $20 million. Let's use this small example. $20 million, comma. However, the subsidiary or parent, all of the above, sends a check of 18 million. Let us don't use 18, let's use 7 million. Subsidiary sent a check of 7 million. Okay. 7 million, comma, but this has not been recorded by parent company. So this is the example I created now. So assuming this question is a small question, now let's treat it. So if I treat this solution, if I treat this example now, everybody will understand what I'm saying. Cash in transit is very, very simple. But if you don't get the trick, there will be problem. Now, parent owes subsidiary 20 million. However, subsidiary have created how much? I've sent 7 million, Abi. Subsidiary have sent 7 million naira. So this is the adjustment. This is what I'm saying. The solution will be, let me copy this. These three items. I'll copy it here. So that I can show the solution. Now, this is what will happen. Now, the subsidiary has done what? The subsidiary has sent 7 million, Abi. Now, this is the adjustment. You just say, add $7 million. This is the adjustment to add $7 million to cash. Now, your receivable must be at 100%. Your receivable must always be higher. By how much? Now, your receivable must be higher, Abi. How much are they owing each other? 20 million. IFRS 10 says all intra-group transactions must be eliminated, Abi. So you now less $20 million from parent company. Now, to now get your payables, it will now be less 20 million minus 7. So it will be $13 million. This is our adjustment. Assuming we are in the exam hall, if examiner give us an example that I just cited now, this is how we are going to do it. You less 20 million from receivable, less 13 million. That means the difference between receivables and cash, the difference between them, you less 13 million from payables. You now add 7 million to cash. This is our adjustment. And that's the reason why I use that example, so that we understand. Here, our payables is 0 because 15 minus 15 is 0. And that is the reason why my payable is 0. My receivable must be owed at 100%. It must be 100%. That receivable must be higher. Sometimes the examiner will just give you 1 and will not give you 1. So this is how to get it. It's very simple. Just add that amount sent by one of them. Add it to your cash. Now pick that cash, pick it, subtract it from your receivable. The difference will go to the payable. Then you now less, and that is the adjustment. That is the adjustment. The adjustment is very simple, but once you don't get the trick, it will be problem. So now let's quickly pass this adjustment. So our receivable will be deducted, right? Less 15,000 from our receivables. Now, to our cash, what's the adjustment? Add 15,000 naira to our cash. Now, to our payables, less minus 0. And that is the adjustment. Whenever we are doing cash in transit, that is the simple adjustment we are going to be passing. But whenever it is goods in transit, it is anytime it is goods in transit, let me just quickly use my mouth to say it now. That goods in transit will come to your inventory. So instead of us to add this 15,000 to our inventory, it will just come here. You add it to your inventory. They will now calculate unrealized profit on on goods in transit again. So that's another adjustment again. But this is foreign subsidiary. This is our own adjustment. This is the normal adjustment we are going to. Okay, yes. Okay, I'll write it. I'll write it somewhere in the sheet. I'll write it. So I'll write it. When it is goods in transit, I'll write it. I'll write it. So that before I send it, I'll write it. Now let's go. Our additional information 3. Now, additional information 3 if you look at it very well, the examiner told us expressly that what this has been included in they said there was a revaluation reserve. Abi, there was a revaluation reserve. There was a revaluation reserve. However, that amount has been what? Has been included in the financial statement. So naturally, it's something we can ignore since it has been included. But for classic, let's solve it. Let's look at it together. And that will be our what? That will be our working note 4. Our cash in transit is working note 3. Then this will be working note 4. So working note 4 is what? Is additional information 3. Additional information 3 that talks about revaluation gain. So revaluation, how much is the revaluation? Revaluation gain on what? Revaluation gain on lease old building. Revaluation gain on lease old building. So now let's determine that revaluation gain. Now, they said we are using Naira, right? Let's use our Naira sign. Let's hang our 1,000. Now, they said on 1st October 2016, right? Yes. On 1st October 2016, the Kemi purchased the leasehold building for 375 BRL Abi. So on 1st October 110, 2016, cost of the building. How much is it? BRL, sorry. This is not Naira, it's BRL. Let's use BRL. It's not Naira. Is how much? 375 BRL. Now, they now said depreciation, Abi. They said he took out a loan to finance but they did not give us information about that loan. Please, we can ignore it. If they give us information about that loan, let's say he took out a so amount loan. I just said he took out a loan note payable. So out of that loan note payable, that was how it was financed. Please, let's go and check. Let's go and check our balance sheet. How much is the 10% loan note for Kemi PLC? How much is it? Let's check in our balance sheet. How much is it? How much is it? Let's check in our balance sheet in the question. Let's use the chat box, please. How much is the loan note in the balance sheet for Kemi? Egole. Is it not 375? 375, yes, 375. And that is what the examiner is telling us. Examiner told us that he took out that loan, and that is what that is the information we are. They said that 375 loan note, he used it to finance the purchase of that building. So that's why I quickly call our attention to it. Now, he now said the building is going to be depreciated for 25 years, happy. So now let's calculate our depreciation. Our depreciation is how much? It will be 375,000 divided by 25 years. Divided by 25 years. So when we press our calculator, it's going to give us 15,000. It's going to give us 15,000. So our depreciation is going to give us 15,000. Am I right? Yes. Our depreciation is going to give us 15,000. Now, what will be our carrying amount? Our carrying amount. this is not 2006. So this is when was the asset purchased? 2016, right? 2016. That was when the asset was purchased. So a year later, that is on the 1st September 2017, the carrying amount before evaluation, carrying amount before evaluation, carrying amount before evaluation is how much? Is 360,000. Carrying amount before evaluation is 360,000. Then what does the examiner say again? The examiner now said they now revalued it. Revalued amount. Revalued amount. For how much? Examiner said they revalued it for 450,000 BRL. 450 BRL. So there's a evaluation gain of how much? A evaluation gain of 90,000. And that was the 90,000 that is in evaluation reserve. That's this surplus is accumulated in the reserve. This evaluation. And that is how we got that 90,000. That 90,000 that is inside the balance sheet. That's how we got it. It is this revaluation reserve that this 90,000. Let me show everybody. Can we see? This, where's our translation? When we are translating, I saw 190,000. This 90,000. You know, when we translated, give us 18. So this is it. And that is why they said it has been included. And truly, it has been included. So this additional information is just to confirm that this 90,000 has been included truly, because the revaluation reserve was 90,000. And that is all about that additional information 4. That is about additional information 4. Now, I think we can balance our book now. Let's balance our book. Have we done the group structure? No. We have not done the group structure. So let's calculate the group structure. Let's do the group structure. Let's do the group structure together. I think we are going to create additional working notes. The cost of what? Determination of parent company's percentage. Parent company percentage of control. Now let's go back to the balance sheet. Or at the beginning of the question, it's like they gave us in the question. Abi, they gave us in the question. They said the parent company acquired how much? 960 million shares, Abi. So parent company percentage of control will be 960 million shares multiplied by what is the total number of shares of subsidiary company. Please, let's go back to our balance sheet. Let's go back to our balance sheet. What is the share capital? The share capital of the subsidiary company. Egoli, how much is it? 600,000. Thank you, man. However, the nominal value is 50 kobo, Abi. Please, let's remember, the nominal value is 50 kobo. So what are we going to do? Let's open a bracket. this will be 600,000. That is the share capital divided by 0.50 kobo. Divided by 0.50 kobo. So divided by 60 kobo, it will be 1.2, right? So 960 divided by 1.2. Thank you, man. So it will be the parent company percentage of control will be how many percent? Will be 80%. Will be 80%. While NCI will be 20%. NCI will be 20%. NCI is equal to 20%. NCI is 20%. So that is our group structure. And we can quickly go to our group structure and construct it. 80%, right? Yes. So that is it. When is the date of acquisition? 110 2016. Is it not 2016? Yes, it's 2016. 110 2016. Sorry, 2015. 2015. It was the asset that was bought in 2016. Sorry. The date of acquisition is 2015. So we are done with that. We are done with group structure. Now let's do our goodwill calculation. So what is the cost of acquisition? So we are told in the question that the parent company purchased it for 1.08 billion abi. So BRL 1.80 billion. So it will be, let's make it this, this, this. So this is it. This is the cost of acquisition in BRL. Now, in BRL. Now, what is the date? We need to convert. We need to convert back to, do you remember? We need to convert this BRL to Naira. So at what rate is it going to convert this? When did the parent company buy these shares? So it's at DOA rate. So it's at DOA rate. Is it DOA or DOC? I think it is DOA. Sorry, excuse me. It's our DOA rate. So what is our DOA rate? DOA rate is 6 divided by 6 abi. So it will be divided by, because this shares was purchased as a DOA, the date of acquisition, divided by 6. So when we press calculator, let's press our calculator. If we press our calculator, 108 divided by 6, it is going to give us how much? It is going to give us how much? It is going to give us 180. Right? Thank you. Thank you very much, Mars and SAS. So it's going to give us 180. So 180,000. That is the cost of acquisition. So when we convert, let me put it here. The cost of acquisition is equal to 1 0.80 billion naira BRL divided by 6, it will give us 180,000. That is our cost of acquisition. Now, NCI value as our DOA, which is how much? 20%. We are using proportionate share of the net asset divided by our net asset. We get our 33, right? So when we add both together, we get our purchase consideration. Now, what is our net asset as our DOA? I've said it here to working note 3, copy and paste. Then we get our goodwill. Goodwill as an acquisition date, it will be purchase consideration minus net assets. So we get our goodwill as at acquisition date. So this is our goodwill as at acquisition date. Now, according to the question, there is no impairment, Abi. So goodwill as at consolidation date is 48 million. So that is our goodwill as at consolidation date, 48 million naira. 48 million naira. That is our goodwill as at acquisition date. However, let's take note. When we are dealing with foreign subsidiary, please don't let us forget. We will calculate exchange gain on goodwill. You know, I said it. Exchange gain on goodwill. And that is our next additional information. I said additional information. Next working note that we need to calculate. I think that will be our last working note 6. Please, exchange gain on goodwill. It is very simple. Please don't let us get it twisted. It is very, very simple. And this is how we will calculate it. Exchange gain or loss. It can be a gain or loss on goodwill. Exchange gain or loss on goodwill. So now this is what we are going to do. We are going to create 3 columns. This will be BRL. Goodwill in B will be BRL. This will be exchange rates. So this will be the exchange rates. Then this will be Naira, because we are changing back to Naira. So let's continue. Now, what is the goodwill? So goodwill as an acquisition date, the one we calculated now at DOA. So goodwill as a DOA is how much in Naira? Please, let's look at this goodwill. This translation of goodwill is very simple, but we must be very calm. Please, let's stay calm. It's very simple. How much is our goodwill? This goodwill is 48,000. Abi in Naira. You know, we have converted in Naira 48,000. So now, this is what we are going to do. Relevant adjustment 48,000. Now, what is the exchange rate as a DOA? The exchange rate as a DOA is 6. So we need to do what? We need to work back. 48,000 multiplied by 6 is going to be 288,000. We want to know the exchange gain on this goodwill. Now, what are we going to do? Impairments. If there is impairment in this question, we take note of it. Impairment, there is no impairment in this question. Now, naturally, if you look at my format in the note I sent, when you are calculating exchange gain on goodwill, please, impairment must be average rate. Do you remember that impairment is an item of P or L? And anything that when you are translating P or L item, it must be at average rate. However, in this solution, we don't have an impairment. So your impairment will be 0. Now, you now leave line for balancing figure. That balancing figure will determine our exchange gain or loss. So we call this place exchange gain or loss, in which we will determine by ourselves now. Maybe it's a gain or loss, we will determine. It will be a balancing figure. Now, this goodwill, this is a goodwill. Goodwill as a DOA and DOC, they are the same. The only thing that changes its exchange rate. So this 288,000 will come down here. Now, you now translate back. What is the exchange rate as a DOC? The exchange rate as a DOC. This one will be a DOA. The other one will be a DOC. Have you seen it? Sorry. It's going to be a division. Division. So can we see it? Can we see it? This 288,000, exactly as we are doing it before. The goodwill, people are giving me reaction. At least I know this exchange gain goodwill, it will be wahala. But let's calm down. It is not that hard. Please, let's calm down. Where did we start from? We start from goodwill as our DOA, which is 48,000 in Naira. They gave us the exchange rate as a DOA. Why? Because goodwill is as a DOA. Let me put it here. Anything that has its DOA, please use DOA. That's the rule. DOA rate. Can we see it? DOA rate. Now, if there is impairment in this question, we use average rate, but there is no impairment. So do you leave one line? There is one line. That one line is what? Is for balancing, is for determination of exchange gain or loss. Now, this 280,000, that is our goodwill in BRL. It will not change. But what will change? What will change is exchange rate. Because exchange rate as a DOC is different from DOA rate. So this will be DOC rate, because we want to determine the goodwill as at DOC. It's as a DOC. So what are we going to do? We can now see 288,000 divided by 5. So the goodwill as a DOC is higher than goodwill as a DOA. Can we see it? And that is why we are doing it. That's why we are calculating exchange gain on loss on goodwill. We want to determine this goodwill, this 288,000, as a DOA and DOC. Are they the same? No. There must be a difference. Is it a gain or loss? Now let's look at it. DOC as a goodwill as a DOC is 57,600, but at the beginning is 48,000. Is that a gain or loss? Let's look at it together. Our balancing figure, is it going to be a gain or loss? It's going to be a gain, because goodwill has increased. Goodwill as a DOA is 48,000, but as a DOC it has increased, so it's a gain, and that is why we will determine our exchange gain. That is how we will determine our exchange gain. And what are we going to do? We're just going to say this minus this, which is 9,600. So this 9,600 is our exchange gain. Now, what is the group policy? The group policy is to what? Is to measure NCI using proportionate net asset method. So this exchange gain belongs to only parent company. Belongs to only parent company. So what is the retained earnings of the parent company in the balance, in the balance sheet. Retain earnings of the parent company. Retain earnings of the parent company in the balance sheet. 525,000. Thank you, man. Thank you, man. So 525,000. Now, exchange gain on goodwill. We have determined that one, Abi. Let's link it. So let me put it here so that people will remember that it is our relevant working note 5 that we got that 9,600. Yes. Working note 6, not 5. Excuse me. Working note 6. Now, is that all? I think that's all. We cannot calculate exchange gain on net assets. Why? Because we are not dealing with P or L items. If we are dealing with P or L item, we will calculate exchange gain or loss on net assets. But this is not a P or L item. So let's just leave it somewhere. Now, that has been done. Now let's balance our book. Let's balance our book. Let's quickly balance our book. So someone says now, let me look at the chart. Now, if it is full goodwill method, it will be shared between parents and NCA. Exactly. Thank you very much, Mrs. Mary or Miss Mary. So, let's do that. Let's do that. Let's do that. So, NCI value as our DOE is copy and paste. Let me put it here. Now, NCI share of post-acquisition retained earnings and NCI share of acquisition revaluations. So this is it. That's why I split these two into two parts. I've split it. Now, and where do I split it? I can just put it here. Voila. Let me pay special so that we can use it. So now NCI share is how much? 20%, right? 20% of 53,250. Why NCI share of evaluation reserve is how much? Equally 20% of 18,000. So if I can use calculator here, 0.2 multiplied by this, I can get this. Then is equal to 0.2 multiplied by 18,000. So that is that. We have done with that. Now, parent company share, right? So what is the parent company share? Is 80%. 80%. 80% of what? So 80% of post acquisition of the group, which is 53,000. Why this will be how much? 80% of 18,000. So we can quickly deal with this. 0.8 multiplied by 18,000. We can get this, then we can quickly get this too. Multiplied by this. So that is it. Any other thing that we need to do? I don't think we have anything else again. I don't think so. So we can do what? We can balance our book now. I think we can balance our book now. This is 11 o'clock. 11 o'clock. 11 o'clock. 11 o'clock. So I think our balance sheet will be balanced. I'm very, very sure. I'm very, very sure. I'm very, very sure our balance sheet will be balanced. But for example, so please don't balance your balance sheet too. So this minus 180,000, your investment usually is 0. Now, our PPE, do we have any adjustments? No. So when we add these two together, what is it going to give us? I've on our mic. Please, can everybody give me figure? Okay,
1,185,000.
Thank you. Okay. 1,185,000. Now, goodwill. Please, let's take note. Goodwill in this place, it will not be the goodwill here. You know that all the goodwill we have been calculating is this one. Please, it's not this one. Oh. It is the goodwill as our DOC is the one we will pick. This one. That is the goodwill we will pick. Oh. Please, let's take note. Oh. This goodwill is the one we will pick. It is not this goodwill. This goodwill is as a DOA. So, and that is another twist to foreign subsidiary. Another twist to foreign subsidiary. Please, when you are taking your goodwill, it should be goodwill that was translated as a DOC. So please, let's take note. Let's take notes. Let's take notes. Thank you very much, sir, for giving me figure. Now, please, can you give me figure? So let's quickly balance this work. Let's close shop for tonight. Okay. So our inventory. Please, how much is our inventory value? Please, you can talk now. I've muted everybody. We can talk now. Okay. 461,250 for 461,250 for inventory. 461,250. Now for trade receivable, how much is it? For trade receivable,
369,000.
369,000. Okay, for trade receivable, 369,000. Now for cash, 30,000 plus 90,000. Please, I know this one.
120,000.
I know this one is 120,000, right? It's 120,000. Now let's go. Okay, I've already linked this. I've linked my reservation reserve. You know, it's coming from working note 2. My evaluation reserve. My evaluation reserve from working note 2. Then my retained earnings, I've also linked this to. This is my retained earnings. Then my NCI for my working note 4. I also have this too. So that is my so my loan notes. So can you help me with the loan note figures and this slide?
375,000.
So how much
375,000.
is my loan note figure? My
375,000.
loan note figure is how much? 300,000 percent 5. It's like I know this one too now. 300,000 percent 5,000. Like I know this one. So it will give me 375,000 for loan notes. Then receivable, redeemable preference shares, 30,000 plus 90,000. I need this one to 120,000. Now it will remain trade payable. overdrafts. So I know overdrafts. 45,000. Now taxation. Yes, I know transaction 129,000. 5 plus 24, 29,000. So 375 plus 60.
435,000
Trade
naira.
payables figure. Trade payables figure. Nobody is giving me figure again.
435,000.
Trade payables figure. People have slept.
435,000.
People have
435.
slept. Voila. Eh? Okay, 435,000. Thank you, ma. Thank you, ma. 435,000. So that is our equity and liability. Now we need to. Oh, sorry. Excuse me, please. Now let's do this. This is our equity plus non-current liability. What am I doing? So this formula, let me change the formula. This plus this plus this total liability. So I need total liability here. So 2,192,850. So our account is balanced. Normally it will be balanced in the class. For class purpose, our account will be balanced. But for exam purpose, please don't balance your account. There is no time. There is no time. And so that's about this foreign subsidiary. We are going to solve one more, probably during revision. Then, by the grace of God, next week we are moving to good cash flow. By the grace of God, I will upload piecemeal. I've uploaded piecemeal past question on the YouTube channel. You can check it. Then, what again? We'll solve good cash flow. Probably last diet past question or the 2021 past question. Then we now solve last diet past question during revision because we don't know disposal of subsidiary. Okay, if there is time, we can solve disposal of subsidiary. If there is time, I think there will be time after we solve good cash flow. I think there will be 1 week before we close class. So that is it. So this is part 11. Little explanation on retained earnings. That retained earnings, and that is why I have recording. Please, the time has gone. I have not eaten. Mr. Benjamin wants to ask a question. Please, can you go ahead with your question? Can you
Yes,
use
sir.
the
Thank
chat
you very
box,
much. Good
please?
evening, sir.
Please
Okay,
use
so
the
sir, my
chat box.
question is
Let's quickly
suppose we are
take your
using
question.
okay, are you with me, sir?
Net asset of subsidiaries. Please, Mrs. Onome, please, if you remember very well, your post-acquisition, when we are translating, it is during your translation, that's when you get your retained earnings pre and post. That translation, and I explained it the first time and second time. So maybe when you watch the recording, you can fast forward to that angle. It is somehow complicated, but when you count that, you will get it. It's not something that is hard. So, Mr. Benjamin, can you go ahead with your question?
Yes, thank you very much. Okay, so my question
Okay, maybe
is
don't have
about
any
that
question.
exchange gain
You are
or
welcome.
loss.
You are welcome. Okay,
Okay, it's about that
because
exchange
the
gain or
class, in
loss.
fact, my laptop is nearly want to off.
Are
So,
you
which
with me, sir?
question do you want to? Can you go ahead with your question? Let me
Yes, it's
check the
about the
chat box.
exchange gain
Maybe
or
you
loss.
have asked a question.
It's about the
There's
exchange gain
nothing
or
in the
loss,
chat
sir.
box. Okay, maybe that question is later question, sir. So, thank you very much, everybody. Let's have a wonderful night first. So Mr. Benjamin is going to ask his question. Hey, I was saying you should use the chat box. Use the chat box. Our time has gone so much. Oh yeah, and if your question is going to be long, so the
No, it's
time
not
has
going to be
gone
long, sir.
already.
It's just a short question.
So I can't hear you. Okay, is it
Can
saying?
you hear
Is
me,
it
sir?
talking?
Can you hear me, sir?
In my speaker is in silent mode.
Hello, can you hear me, sir?
Okay, yes, I can hear you now. Yes, I can hear you now.
Okay, so my question is, suppose that exchange gain happens to be exchange loss, it's going to be deducted from the consolidated retained earnings, right?
Exactly. Yes, you are going to deduct it. Thank you for that.
Okay.
Thank you for
All
that.
right. Then
So
the second
everybody, let's
question
take
is,
note. Yes, everybody, let's take
second
note.
question
When
is
it is
if
exchange loss, yes. If yes, yeah, go ahead.
if, for example, now we are using fair value method, how will the
Yes.
impact be on NCI computation? Suppose the NCI is 20%.
So for the exchange loss, Abby,
No, exchange gain that is going to
exchange.
be shared between parent and subsidiary. How will
So
it impact on the NCI computation?
yes, this is just it. You just go to your NCI calculation in your working note 4. So you just come here. We are just going to insert in another row here. You just put NCI share of exchange gain. NCI share of exchange gain. You just calculate 20% of that exchange gain. They will give NCI. They will now come to the parent company. Parent company share of exchange gain. Parent will now collect 80%. So parent will collect 80% of 96. Subsidiary, which is NCI, will collect 20% of 96. They will now put it here. So that is just it. That is just it. Both of them will share it if it is at fair value method. So that is how it is going to be impacted. They will share it between the two. But in this question, it belongs to only parent company. So that is why we took that 96 here straight away. So that is just it. So thank you very much, everybody. We are going to continue our class next week by the grace of God. So thank you very much. Good night, everybody. Let's have a lovely night rest.
Thank you, sir. We really
Bye-bye.
appreciate your effort,
Thank
sir.
you,
Sweet
sir. Good night,
dreams.
sir.
Enjoy
Good
your
night.
meal, sir.
Go and eat, please.
Enjoy your meal.
Okay, thank you very much.
You're
Bye-bye. Good
welcome, sir.
night.
Yeah, good
Good
night.
night.
It is not good, sir.
The network, Abby.
No, don't eat
I'm
late
good,
at night.
sir.
It's not good.